Monday gave you the whole story in one bar. The S&P opened up 0.4%, tried to shake off Friday's war scare, got as far as 75.13, and sellers ran it all the way back down, 74.43 at the bell, down 0.2, within 3 points of the day's low. Oil told the rest of it. Brent touched 91 on the 9th day of American strikes on Iran, then gave almost all of it back by the settle. And the bounce still failed anyway. My read, the pressure has moved from oil to rates. The 10-year climbed to 4.59, a few basis points off its July high, and that's the number doing the squeezing. Tonight I'll prove it chart by chart, and I'll leave you with the two numbers that decide Tuesday. Start with the record, because the weekend redrew the board. Yemen's Houthis declared a naval blockade against Saudi Arabia on Monday. Reuters broke it in the morning, aimed at the Red Sea route the Saudis have been using to move barrels around the block strait. NBC News puts that workaround near 4.5 million barrels a day out of Yanbu. Read the declaration again. The workaround is now the target. When the detour itself gets blockaded, the market has to price the whole region. And the strikes themselves hit day 9. NPR has the shape of the weekend. 9 straight days of American bombing since the peace talks collapsed over the Strait of Hormuz memorandum, and a third American service member killed in operation since Friday. Central Command says the newest wave targets Iran's ability to hit commercial shipping. Iran answered in kind. NPR counts a strike near the American position at Al-Tanf in Syria, and drone attacks on 2 bases in Kuwait. The second straight day, Kuwaiti infrastructure took fire. The president said Iran, quote, will pay. So both oil routes out of the Gulf are contested at once. The retaliation is widening, and that's the backdrop every chart tonight sits on. Brent's daily bar shows you exactly where the war premium stands. It opened at 89.30, ran to 91.42, a new July high, traded as low as 86.12, and settled at 88.80, up just 0.6 on the day. That's better than a $5 range inside one session. Now, the levels. 87.55 was the spike high from the week the straight first shut. Nothing closed above it for a month, and now Friday and Monday have both settled above it, so the old ceiling is acting like a shelf above. Monday's rejection at 91.42 is the line the bulls have to reclaim. For context on the run into Monday, Friday alone jumped 4% off Thursday's close at 84.85. Monday's stall came at the end of that run. CNBC puts crude up roughly 20% for July. For scale, on why this matters beyond the pump, before the war, the EIA counted about 1/5 of the world's petroleum liquids moving through Hormuz every day, and first quarter flow already ran close to 30% below last year. Monday just showed you it needs fresh escalation to grow. Energy stocks held the move better than crude did. XLE closed at 57.94, up about 0.5% on a red tape after printing 58.39, a new July high. Friday's video named 57.30 as the breakout trigger, and the fund has now closed above it 2 sessions in a row. That's what a real breakout looks like. Old resistance got tested from above and held twice. The line in the sand is unchanged. Hold above 57.30 on a retest, and energy stays the leadership sector. Slip back under it, and the whole move gets reclassified as premium that leaked into equities and leaked right back out. Drill one level down, because the sector fund is being carried by its heavyweights. Exxon closed at 148.36, up about 0.7 after tagging 149 on the day. The July ceiling sits at 150 even, Friday's tag, and Exxon has now spent 2 sessions knocking on it. A daily close through 150 puts the biggest name in the fund at new July highs with a war calendar behind it. Chevron is a step ahead. It closed at 189.71, up 1.25%, and printed 190.35, a fresh July high. On a day the broad market closed red, when the number 2 name in the sector makes new monthly highs on a red tape. That's real buying, and it's the strongest evidence on the board that the energy rotation has money behind it. Strength like that in the oil names only holds if the bond market confirms the inflation story. Monday it did. The 10-year Treasury yield rose 4.5 basis points on Monday and settled at 4.59. Session high a touch above 4.6. A few basis points under the July high at 4.64. My read starts with what didn't happen there. On a day with a blockade headline and American casualties, money did not hide in treasuries. Yields went up. That's the oil to inflation channel doing exactly what the textbook says. A 20% crude move feeds inflation expectations. Inflation expectations keep the Fed careful, and the discount rate on every long duration asset creeps higher. Gold settled flat at 4,007. No haven bid at all, on exactly the kind of day that usually produces one. Put Put those together and you get an orderly repricing driven by the rates map more than the headlines. Now watch what that rate pressure did to tech. The Nasdaq 100 opened up nearly 1% at 28,871, tagged 29,017, and then spent the whole session giving every point of it back. Closed 28,604, flat on the day. The level story is uglier than the flat close. 28,814 was the July floor that held twice. The index has now settled below it, 2 sessions running, so old support is now overhead resistance. Underneath, Friday's low at 28,231 is the July low and the last defense before the June range, which tops out near 28,200. Very little shelf between Friday's low and the round 28,000. Monday's low was 28,590. It never tested Friday's low, so the selling stayed orderly. An index that can't hold a 1% gap on good overnight footing is an index where the marginal buyer has stepped away. Now the S&P itself. Friday's video said the constructive read survives only above 75.04. Monday was the second straight settle below it, 74.43, with the session low at 74.40, about 19 points above the July low at 74.22. 19 points, give or take. That's the entire cushion between pullback inside an uptrend and the July range is broken. Brent agreed with the sellers. The Dow gave up 0.6, 307 points, the worst of the 3 averages. And the top of the structure hasn't moved. The July high at 75.81, printed July 15, sits untouched above all of this. The index is still only about 1.8% off its July high, so nobody serious is calling this a crash. But an index losing its line while yields press their July high is how orderly pullbacks become trends. The VIX barely moved Monday, and that's the story. It closed at 1866, off a tenth on the day, but sitting in the top quarter of its July range after Friday's jump from the 16s. It didn't spike on the blockade headline, and it didn't bleed back to 15 either. For the frame, the July floor is just under 15. Thursday closed 1672, and the July top at 1950 printed Friday. Monday parked between them, closer to the top. The options market has settled into a new, higher resting heart rate into the biggest earnings week of the month. Is carrying the war as a standing risk and charging a standing price for it. One honest correction to Friday's map before I redraw it. 75.04 broke, but yields never broke lower. The selling repriced inflation, money never ran to safety. So here's the new map, starting with the index. Base case is the squeeze. The S&P box between 74.22 and 75.04 into Wednesday's earnings. Losing 74.22 on a settle opens the June range below. Reclaiming 75.04 retires the whole bearish read. For scale, JP Morgan's official year-end target sits at 7,200. The big desks will brace for lower well before this week. Crude side of the map, base case keeps Brent boxed between 87.55 and 91.42 while the diplomacy question hangs. Escalation is a settle above 91.42. And if the disruption persists at that scale, Goldman's April scenario works sketch Brent north of 100. That's the outer edge of the map, and I'm not forecasting it. De-escalation runs the other way. Renewed diplomatic contact is the trigger, and the confirmation is a settle back under 87.55. That's when the week's premium starts coming out. Rates arbitrate all of it. The 10-year clearing 4.64 confirms the inflation premium and reprices every equity chart in this video, while holding under it keeps the squeeze orderly. And energy tells you whether the rotation is real. The 57.30 retest holding says the rotation is real money. A slip back under it says the whole move was war premium passing through, and I'll call it that way if it prints. The calendar decides which way this breaks. Wednesday after the close, Alphabet and Tesla, the first of the mega cap prints, with Alphabet's capital spending as the AI. I signal everyone actually cares about. Plus IBM's full call, 5 o'clock Eastern, after its preliminary release cost the stock 25% in a day, the worst day it has ever printed. The same week brings Intel, General Motors, Lockheed Martin, and AMD. The calendar gives you jobless claims Thursday and the July flash PMI is Friday, and the Fed is in blackout until the decision on July 29th, so the bond market has no speeches to trade against, only the oil chart. Quick recap, so you walk into Tuesday ready. Both Gulf oil routes are contested. Brent needs 91.42 back to prove the premium is growing. 87.55 is the shelf underneath. Energy is the breakout that stuck, as long as 57.30 holds. The Nasdaq's old floor at 28.814 is now its lid, and Friday's low at 28.231 is the last defense. The S&P sits about 19 points above the July low at 74.22, and the 10-year 4.64 is the line that turns a pullback into a trend. If you only keep 2 numbers for Tuesday, keep those. 74.22 on the S&P, 4.64 on the 10-year. The completed bars will answer same as always, and I'll walk you through whichever answer prints. If a desk that talks in settled levels instead of headlines is useful to you, subscribe. It's one click, and it keeps this thing daily. See you after the close.